Welcome to this video on stock options and how do they work. Today we'll be looking at what is a stock option, types of stock options, what are the risks. It is important to understand the risks before using options. When applying for options permissions at your broker, they will likely want to know how much you understand them. And option terminology. Knowing the terminology can also help prove that you understand options well enough to be using them. But first, what is a stock option? A stock represents ownership in a company. Ownership is divided up into a number of shares, and the number of shares owned represents the percentage of ownership of the company. And stocks can be bought and sold on a market. It's a simple enough definition. What is a stock option? A stock option is a contract between two parties to let one of them buy or sell a certain amount of stock at a predetermined price, if they choose to, at any time between now and a certain date in the future. This is an anonymous contract. It's not like you are approaching a certain person. You never know who's on the other side of it. So it seems like you're just working with the market in general. The price is called the strike price, so remember that. The date is called the expiration date, and is usually a Friday. In any agreement, one party buys and the other sells. And the amount of stock is usually 100 shares. There are only two kinds of options. They sound like a complicated thing, but when you boil it down to, it's actually fairly simple. The first is a call option. Call option gives the owner the right to buy the underlying stock. As the owner, you can buy the stock at the agreed price no matter what the current price is. Of course, you'll only do this if the current market price is higher. Otherwise, it is just better to buy the stock directly on the market. And in this case, you will let the option expire. The other type of option is called a put option. It's kind of the opposite. It gives the owner the right to sell the underlying stock. Similarly, you would only sell the stock price at the agreed price if the market price is lower, so you can actually sell it for more than you would normally be able to. Buying or selling, you can buy or sell both types of options. So it basically gives you 4 different types of operations. Buying gives you the option in exchange for a premium. Selling gives you an obligation in exchange for a premium. In both cases, the premium is kept by the seller. And that's important. Even if the option is never used, the seller keeps the premium. Premium is quoted as a per share price. This means that the amount paid will be 100 times that quoted price. So if the premium is $2, the cost to buy a contract will be $200. Let's look at some examples. This is a common way to express the details of an option. AAPL indicates the stock, Apple in this case. 01/17/2025 indicates the expiration date. 225 is the strike price, $225. And C means it is a call option. The holder of this option can buy 100 shares of Apple stock for $225 per share, total of $22,500, at any time up to and including January 17th, 2025. Another example. TSLA indicates the stock, Tesla. Both AAPL and TSLA are the market tickers for those stocks, and it's what you would use if you were buying or selling the stock, or if you were just doing a price lookup, say. Again, the date refers to the expiration date. 220 is the strike price, $220, and P means that it is a put option. The holder of this option can sell 100 shares of Tesla stock at $220 per share $22,000 in total, at any time up to and including January 17th, 2025. So what are the risks? The risks depend on whether you're buying or selling the option. When you buy a stock, the risk is that the price will drop and the shares will be worth less. If you sell a stock short, the risk is that the price will increase and you'll have to pay more to buy it back to close out your position. When you buy the option, you pay the premium, and that is the most that you can lose, no matter what happens. When you sell the option, you receive the premium, cash right in your account right away, and that is the most that you can gain. Losses, however, can be unlimited in certain conditions. Let's look at each case separately. When you buy a call option, you pay a premium that you don't get back. The profit you make depends on the underlying stock price when you exit the position. At expiration, the break-even point is the strike price plus the premium. As shown here, that is 50 plus 5, $55. Above that price, the option is worth more than you paid for it. The value of the option will increase dollar for dollar with the stock price. When you sell a call option, you receive a premium that you keep. The profit you make depends on the underlying stock price when you exit the position. At expiration, the break-even point is the strike price plus the premium. As shown here, 50 plus 5, $55. Above that price, the option is worth more than you paid for it. The value of the option and the amount of your losses continues to increase dollar for dollar with the stock price. When you buy a put option, you pay a premium that you don't get back. The profit you make depends on the underlying stock price when you exit the position. At expiration, the break-even point is the strike price minus the premium. As shown here, that's 50 minus 5, $45. Below that price, the option is worth more than you paid for it. The value of the option will increase inversely with the stock price. So as the stock price goes down, the value of the option will go up. When you sell a put option, you receive a premium that you keep. The profit you make depends, again, on the underlying stock price when you exit the position. At expiration, the break-even point is the strike price minus the premium. As shown here, that is 50 minus 5, $45. Below that price, the option is worth more than you paid for it, and the value of the option and the amount of your losses will increase inversely with the stock price. The stock price cannot go below zero, so there is a limit to the loss. Let's look at some examples. Let's say you buy a call option with a premium of $1.50 and you pay out $150. There are basically three ways to close out the transaction. At any time, you can sell the option for the current premium, and this could be higher or lower than the premium you paid to buy it. So you'll make or lose money depending on what that value is. At any time, you can choose to exercise the option and convert it to 100 shares by paying 100 times the strike price. And this would be in addition to the premium you paid to buy the option. Or the option can expire worthless. You basically just sell it for zero at the expiration date. And you paid $150, and that was a loss in this case. Or let's say you sell a call option. Again, premium $1.50, and you receive $150 in this case. There are still basically three ways the transaction can be closed out. At any time, you could buy the option for whatever it's worth then, and again, the difference in those two premiums will say whether you made or lost money. At any time, the option can be exercised, forcing you to sell 100 shares and receive 100 times the strike price. So you'll receive money, but you will have to provide the shares. And that could leave you in a short stock position if you did not own 100 shares of the underlying stock. The option can also expire worthless. So you would basically buy it for zero, and you would have received the $150. Let's say you buy the put option with a premium of $150 and you pay out $150. Again, the three ways to close out the transaction. You could sell the option for whatever it's worth at that time, could go up or down, and you'll make or lose money depending on which of those cases happens. Or at any time, you can choose to exercise the option and sell 100 shares and receive 100 times the strike price. So typically you would have the shares and you would then sell them. If you didn't have them, you would be short, but you'll receive the cash instead. Or the option can expire worthless. And again, it's like selling it for zero at the expiration date. Last example, let's say you sell a put option. Premium of $150, you receive $150. The three ways remain. At any time, you could buy the option for whatever it's worth at that time and make or lose money, depending on the difference of those two premiums. But at any time, the option can be exercised, forcing you to buy 100 shares and pay 100 times the strike price. So you'll have received the 150, but now you've got to pay the cash of 100 times the strike price, and you will then get the shares. Or the option can expire worthless, and again, it's like you're buying it for zero. So you kept the $150, and after expiration, you don't have any further obligation. Let's look at some options terminology. Premium, I mentioned that one several times. This is the price the option costs to buy. And again, it's a unit price. Right. Often people will say they wrote a contract. This means really that they just sold the option. Short, again, is selling the option. Typically, you're long or short something. If you have a short position, then you owe it to somebody. You sold it. And it's often referred to or expressed as a negative number in your positions. Long would be expressed as a positive number and is the opposite of short, and it's when you've bought something and you still have it. Underlying, we refer to that. This is the stock that the option refers to. So when a stock option is exercised, the stock that's traded is the underlying stock. Expiration, this is the last day the option can be used, and it can be used all the way up until the end of that day. Expired, now we're past the expiration, and the option is now worthless and can no longer be exercised, and that happens after the expiration date. Exercise, this is when the owner forces the other party to buy or sell the underlying at the option strike price. And you can only do this if you own the option. Assigned, this is the opposite kind of exercise. It's when you must buy or sell the underlying at the option strike price. And this can only happen if you sold the option, so if you were short the position. And it's called assigned because, as we mentioned before, these are all anonymous contracts. You're not dealing with a particular person. So there's basically a pool of people who own the option and an equal number of people who are short the option. And when one from the owning pool decides to exercise, someone will randomly be chosen from the short pool, and they'll be assigned and be put together. So not everybody chooses to exercise at the same time if it's before the expiration. So you don't know. That's why you could be assigned at any time. ITM, that's an abbreviation. You might even see that on your broker website. It means in the money. And that means that your strike price and market price are such that your option is worth something. You might choose to exercise it. And that's different for calls and puts. For a call, the option is in the money when the market price is higher than the call price, meaning that you could buy it for lower than you could on the open market. And for a put, it's the opposite. Since you're selling, If your option allows you to sell at a certain price and the market itself is lower, then that would be in the money. Out of the money is basically just the opposite. So OTM, abbreviation for out of the money. That is when it's not worth anything. It would not be to your advantage to exercise the option. Intrinsic value, often referred to as IV, this is the amount that the stock price is in the money. So in the case before, say we have a call, a $50 strike price, and the market is 52, we have $2 of intrinsic value. Similarly, for a put, if the market's 48 and we have a $50 put, we'll also have $2 of intrinsic value. And it's important to remember that intrinsic value is always a zero or positive number. It's never a negative number. Time value. This is a really important concept and it will deserve its own video. Time value is the option price minus the intrinsic value. Sometimes it's referred to as an extrinsic value. And this refers to a value, it's the price that you'll have to pay, kind of like an addition. Even if an intrinsic value, if an option is out of the money and you want to buy it, it's not worth zero. It's worth something. And that something is the time value. So sometimes a premium is composed of a non-zero intrinsic value and a non-zero time value, or sometimes it's a zero intrinsic value and a non-zero time value. And that time value will change depending on many different criteria. And we'll go into all of those in a separate video. So thanks for listening.